Understanding municipal bond yields. There are some important differences between muni bonds and treasury bonds. Muni bonds are riskier than treasuries. They're also less liquid, meaning that an investor's ability to sell them at any given time at a market price without a big price impact is not as great as for treasuries. Finally, munis have an important tax advantage for taxable investors. The interest income received from munis is exempt from federal taxation. In most states, the interest on munis issued by governmental entities within the state is also exempt from state taxation. This additional state-level exemption is why some providers of municipal bond mutual funds, like Vanguard, offer state-specific muni bond funds, like a California-only fund. From a diversification standpoint, state-specific funds would be worse than funds that pool muni bonds across all states, California, New York, Florida, etc. But for residents of a state like California, which has a relatively high income tax, there can be substantial tax advantages to keeping one's muni bond investments within the state. For decades, from at least the 1950s through the early 2000s, high-grade muni bonds traded at yields that were below those of treasury bonds. The average difference in yield, or the spread of the well-known bond buyer index of 20-year munis relative to treasuries between 1953 and 2007 was negative 1.01%. The muni bonds yielded less than the treasuries. But from 2008 to 2013, the average spread was positive 0.69%. The muni bonds yielded more than the treasuries. And as of March 2013, the spread was as high as plus 1.21%. That means that muni bonds traded a yield that was 1.21% higher than treasury bonds. So the question I want to consider here is, why did muni bonds used to trade at yields below those of treasury bonds, and why do they now trade at yields above those of treasury bonds? The three key candidate factors are, number one, default risk differences, number two, differences in the liquidity premium, and number three, taxation. Let's take these one by one. First, market perceptions of default risk may be somewhat higher today than they were in the past. That might in part explain the change in muni spreads. Today there is clearly some default risk priced into muni bonds, and there are yield differences among muni bonds that likely reflect differences in perceived default likelihood. For example, state general obligation bonds, state GO bonds, generally trade at lower yields than local bonds, reflecting the additional revenue sources that states have access to. And even among states, we also have some differences in perceived default risk, with Illinois bonds in particular trading at substantial spreads to the bonds of most other states. Why else might muni spreads to treasuries be higher than in 2007 and before? The second explanation is that the convenience factor of the extreme safety and liquidity of treasuries may have become more important since the financial crisis. That would also explain why muni bond spreads have increased so much. But neither of these factors, neither the safety and liquidity factor nor default risk, explains why muni yields used to be below treasuries and were that way for so long. To explain that, we have to understand the tax treatment of muni bonds versus treasury bonds and corporate bonds. Let's start out considering a fully taxable corporate bond and use that as a point of comparison. For example, consider a 10-year corporate bond with a coupon rate of 8% paid semi-annually. If this bond has a price of $1,000, then the semi-annual yield to maturity will be 4%. But taxable investors in this corporate bond do not get to keep all of those cash flows. If you as an individual own such a corporate bond outside of a retirement account, you must pay income tax on each coupon payment at your tax rate on interest income. That tax rate is usually the same as your ordinary marginal income tax rate, which I will abbreviate here as the Greek letter tau. This is simply your tax bracket, or to be more precise, the tax rate you will pay on an additional dollar of earned income. Here are the marginal tax rates for a married household doing a joint filing for 2013. So if your household earns up to $72,500 in that year, the rate is 15%. If it earns $72,500 to $146,400, it is 25%, and so on. The top brackets are 35% for households earning around $398,000 to around $450,000, and 39.6% for households earning above $450,000. Don't confuse this with your average tax rate, which is your total taxes paid divided by your total income. These are marginal tax rates, the rate on an additional dollar of earned income, say if you worked some extra hours or took a side job. We can now define the after-tax yield on a bond as the regular observed yield to maturity at which the bond trades, which is R, times 1 minus tau, 1 minus the tax rate. This after-tax yield is the yield that prices the bonds, taking account of the fact that the investor in the bond pays a tax rate of tau. So if the investor pays, say, a 35% federal tax rate, then the after-tax yield to maturity on the bond is 4% times 1 minus 35% equals 2.60% semi-annually versus 4% pre-tax semi-annually. In annual terms, that is 5.2% after-tax versus 8% pre-tax. Of course, if you're also in one of the 40 or so states that also tax income, you would have to consider the taxes paid to that state. For example, many people in California pay income tax at a 9.3% rate. One could approximate the combined federal plus state tax rate in this case as 35% plus 9.3% equals 44.3%. But since state taxes are deductible when you file your federal taxes, you can instead think of your net of tax take-home rate as 1 minus the federal rate times 1 minus the state rate, or here 1 minus 35% times 1 minus 9.3% equals 59%. That is the share of every dollar in interest income that you get to keep, 59%. In this case, the after-tax yield on the corporate bond, in the example for the investor in question, is R, the pre-tax yield, times 1 minus the federal rate times 1 minus the state rate, which is equal to 4% times 59%, or 2.36% semi-annually. Again, compared to 4% pre-tax. So the after-tax yield is even lower now once we've considered state income taxation as well. What does this have to do with muni bonds? Well, suppose that the above bond were a municipal bond instead of a corporate bond, and were issued in a state whose income tax code allows the deductibility of interest from in-state muni bond issues against state income taxes. In this case, no federal tax would be owed on the bond, and no state tax would be owed on the bond. So the before-tax and after-tax yield on the muni bond would be 4% every 6 months, semi-annually. This would be a much better deal for a taxable investor than a 2.36% semi-annual yield. In fact, we can define something called the equivalent taxable yield, or taxable equivalent yield, for the muni bond. The equivalent taxable yield is defined as follows. It's the rate that a fully taxable bond of the same credit quality would have to provide to the investor in order for the investor to be indifferent between the taxable bond and the muni bond. In this case, that equivalent taxable yield could be solved for as follows. The equivalent taxable rate times 1 minus tau federal times 1 minus tau state, that's the percentage of a dollar that you get to keep, equals the tax-free muni rate. Plugging in the numbers, we have the equivalent taxable rate times 59% equals 4%, so the equivalent taxable rate is equal to 4% divided by 59%, or 6.8%. What does that mean? Well, that means that a taxable investor, so an individual or a household buying this muni bond outside of their retirement account, a taxable investor would be indifferent between a bond that is yielding 4% and is a muni bond and is not taxable, and a taxable corporate bond that is yielding 6.8%. That is, if she faces a 35% federal tax rate and a 9.3% state tax rate. Also, remember that if you want annual bond equivalent yields, you have to multiply all these yields by 2. One can easily assemble a taxable equivalent table using this calculation. That table gives the taxable equivalent yield for investors in different tax brackets investing in bonds with different yields. These calculations make it clear that the higher the tax bracket and the higher the yield, the more valuable the muni bond tax exemption. Why did I choose to compare muni bonds to corporate bonds here to get these taxable equivalent yields? Why not compare muni bonds to treasury bonds? There are 2 reasons. First, as I mentioned before, treasury bonds are both less risky and more liquid than either muni bonds or corporate bonds. This almost certainly affects treasury bond yields. On both liquidity and risk, high-grade munis are more similar to high-grade corporate bonds than to treasury bonds. Second, treasury bond interest actually also has a tax exemption feature, not at the federal level, but at the state level. That is, if you own a treasury bond in a taxable account, you must pay tax on the interest to the federal government. However, you do not have to pay tax on the interest to your state government, even if the state government charges income tax on earnings and investment income. So the equivalent taxable yield for tax-exempt munis would be a bit lower if we were comparing them to Treasury bonds. But again, because of the extreme degree of safety and liquidity of Treasury bonds, the comparison between Treasuries and munis is just not as apt as the comparison between Treasuries and corporates. So to recap, the tax treatment of muni bonds lowers their yields relative to what they would otherwise be. For many decades, high-grade muni bonds traded at yields that were below the yields of Treasury bonds. But since 2007, some combination of liquidity and default considerations have led to positive spreads of 20-year muni bonds over 20-year Treasuries.